In this final session, we are looking at a number of labour ratios. It's very straightforward. If you learn the formula associated with each ratio, you should have no problems with this section. Now, we have 4 different ratios we need to look at. The first of those is our labour turnover ratio. So what we are measuring here is how often or to what extent do our staff leave the company? What percentage of our staff have left during the prior period? Now, the way we calculate this is the number of staff leaving and needing replacement multiplied by 100%. I'm just circling the needing replacement bit. Now, there might be a number of different reasons why our total staff numbers change. So at the start of the year, we might have 100 people working for our company in total. At the end of the year, maybe we have only 80. But this isn't necessarily because our staff have chosen to leave. If our results haven't been good for the past few years, we may decide that we need to reduce our staff numbers and make a number of redundancies. If that happens, then we don't include that as part of our turnover ratio. Likewise, we don't want to include the effects of any expansion of our company. So if our company expands, we may decide to bring in more people to cover the workload. Again, we don't want to include this in our labour ratio. So the only people we are considering are the people who handed in their notice and left the company, and we had to spend time and money replacing those people. Then we divide that by our average number of employees. The average number of employees may be given to you, or you may just quickly need to calculate it by taking the average of the number of employees at the start of the year and the number of employees at the end of the year. Okay, our second ratio then is our labour efficiency ratio. What we are looking at here is were the units produced in more or less time than planned. So remember from our bonus calculations, we might have said at the start of the year, we expect each unit to be produced in 2 hours. So at the end of the year, we want to look at all of the units that have been produced and calculate. Has this production taken more or less time than expected? This gives us our labour efficiency ratio. We calculate it by looking at our actual output in standard hours. This is the time we would expect production to have taken. In total terms. We divide that by the actual time it has taken and multiply it by 100%. Now what we want to have is a labour efficiency ratio of greater than 100%. If this ratio is more than 100%, it means that our staff have been more efficient than expected. So it has taken them less time than we expected them to produce each unit. Our next ratio then is our capacity ratio. In this, we are looking at were there more or less hours in total available than planned. So at the start of the year, when we were doing our budgeting work, we may have worked out, given the number of production line workers we have and how many hours they work in a year, we would expect to have 10,000 labour hours available in total. At the end of the year, we then want to see how many labour hours were actually worked. Was this more or less than we expected to have available? If people ring in sick frequently or just don't show up to work, then that is going to decrease the total number of hours we have available to us as a resource. So our labour capacity ratio looks at, did we have more or less resource available to us in relation to labour hours? And again, we want this ratio to be greater than 100%, indicating we have more hours available to us than we thought. Finally then, we have our production volume ratio. This is just a combination of our capacity and our efficiency ratio, but what it tells us is we're more or less units produced than planned. And they are our 4 labour ratios. Let's have a look at an exercise then to calculate each one. So we're told a company has the following information for a period. Our budgeted labour hours total was 10,000, actual labour hours were 9,000, and our standard hours of actual production were 9,800. Remember, our standard hours of actual production is the number of hours we would expect it to have taken to produce our units. There were 52 employees at the start of the period and 71 at the end. 5 employees left and were replaced. And we need to calculate each of our 4 ratios. So starting then with the first one, our labour turnover ratio. Remember, our labour turnover ratio will just be the number of staff leaving and needing replacement divided by the average number of employees. So if we just do a quick calculation to work out our average number of employees, that will be our employees at the start of the period plus our employees at the end of the period divided by 2. We work that out, we get 61.5. Now I know we cannot have half an employee, but in order to keep our ratio mathematically correct, we're just going to leave it as it is. So our turnover ratio then will be the number of employees leaving and needing replacement, which was 5, divided by the average and multiplied by 100%. If you work that through then, you should get 8.13%. So the number of people who left and we had to spend time and money replacing them was 8% of our average number of employees. It's difficult for us to know just with this information whether this is good or bad. Different companies will have different targets for their labour turnover. Either way, the management of the company need to understand what is an acceptable labour turnover ratio. Moving on to our second one then, labour efficiency. This is going to be our actual output in standard hours divided by our actual hours. If we look at the question, we're told our actual hours were 9,000 and our actual output in standard hours was 9,800. So this should be very straightforward then. Our efficiency ratio is 9,800 divided by 9,000 multiplied by 100%. That gives us 109%. So this is good news. If our efficiency ratio is greater than 100%, it means it has taken our staff less time than expected to produce our units. On again to our capacity ratio. Our labour capacity ratio will just be the actual hours worked divided by the budgeted hours. We know that there were 9,000 hours worked in total divided by the 10,000 hours that were budgeted at the start of the period. Multiplied by 100%, we get 90%. So this is bad news. As a company, we thought that our labour resource would be 10,000 hours in total. But actually, we've only managed to get 9,000 hours out of our production line workers, which is why our capacity ratio is less than 100%. Finally then, our production volume ratio is just our capacity ratio of 90% multiplied by our efficiency ratio of 109%. If you work that through, you should get 98.1%. Remember, our production volume ratio looks at, did we produce more or less units than planned? And again, we want this ratio to be greater than 100%. As this company has a production volume ratio of 98%, it means we have produced less units than we planned throughout the course of the year.